quick disclaimer, everything that me and Mike talk about in this video, do your own research. We are not financial experts or advisors, so do your own research. Welcome to the very first show of me and Mike's show about investing for Investments. Today we're going to go over the very basics, where you're actually going to start investing. So Mike is going to teach me about how you pick a good fund. So all of our listeners and all the people that's confused when all of those nice, pretty numbers come up and don't make no sense. So Mike, the first thing to look at when it comes to a fund, I know, is it an index fund? That's very important. And then also the expense ratio, actually how much you get charged for choosing to have your money in that fund, because you always have to pay a little bit.
Yes, it's an excellent question. I'm going to start by showing a chart first, because this is a basic understanding everybody needs to have of stocks. Now, this is the Dow Jones Industrial Average. There are many different averages. When we talk about an index fund, that is a fund that tries to copy a specific average or specific index. The reason I'm showing this chart for everybody today, this starts in the year 1900, way over here on the left-hand side, and it goes all the way through 2024, or current time in January. What you want to look at is this long-term rise over time of stocks. Now, this average included stocks for each year. Now, obviously, some companies go out of business and they leave the average. Other companies come in. This right here, this peak right here is 1929, the big stock market run up, and then we had the Great Depression. The time from the bottom of the Great Depression, if you had not sold any of your stocks, even with the companies that went out of business, if you had kept the stocks you owned, and you had owned shares in this, you had owned the companies that are in this average, it took you 11 years to get back to this point. You had more money than you did before the crash. And then, over here, you're making more and more and more. But there are these dips in between. And those dips are extremely important to understand. When we own shares in an index fund, we're going to see those rises and dips. It's not a smooth line. That's called volatility. That variation in value is called volatility. When you go to look for an index fund, you look at an index fund that mirrors an index that you like. The original index fund was created by a guy named John Bogle at Vanguard, and he called it the S&P 500. He took equal shares of all 500 companies that were in the S&P 500 index, and he said, our index is going to copy that. When those companies go down, we'll sell. When they go up, we'll buy, and so on, just to balance out the index. There are mathematical assumptions made in that kind of an index, as with all indexes. But the point for most investors of getting an index fund as their base is that now you have something that's going to copy the market. Now, there are many indexes, as I said. There are some indexes that copy, car companies, or they copy solar companies or whatever. A broad-based index like the S&P 500 covers all the sectors in the market. So for someone that wants to have a base investment that copies whatever the broader stock market is doing, that's what you would do. My personal favorite index is the Morgan Stanley Capital Index. And that's for mathematical reasons why I like it better. And there are funds that copy that index. So there are many different ways to go. So that's the basics of an index fund, is that you as an investor are not having to buy and sell and trade shares of all these different companies all the time. The index does that for you automatically. Expense ratios you asked about. Financial people are really good at hiring accountants that then make sure that it's confusing as possible to understand their fees, and then they hire lawyers on top of that to make it even more confusing. What you want to look at with an expense ratio, that is going to be in a document called the prospectus. Every fund in the U.S. is required by the Securities and Exchange Commission to publish a prospectus. It's usually not too long. They're 30 to 40 pages. And they explain what the fund invests in, what their goals are, what they're trying to do, and pay particular attention to the back pages where they talk about fees, because they bury that way back in the teeny tiny little print, hoping you won't read it.
A quick tip for that specific thing: if it's a PDF that you download to your Chrome or your Internet Explorer on a PC, I don't know which button it is for Mac, just click Control F, you search in the document, you type in fees, and then all of the places where fees are mentioned, they pop up, and you just click next until you get the percentage. You can also put a percent in there. It's the quickest way to read it. Also, if there's other important things that you have learned you need to know, just type that in. It saves you so much time.
What you're looking for in the prospectus, it'll say the expense ratio of the fund. That's how much percent they're going to charge you every year for you to own that fund. That's based on a percentage. So if you have $100 and the fee is 0.1%, you're going to pay 0.1% of $100.
No matter if they win or lose, right?
Right. If you have $1,000 in the fund, you're going to pay 0.1% of 1,000. So it's a percentage of how much you own is what you're getting charged. This is good for the investor in an investing fund because your percentage doesn't change. The amount you're paying changes. As they make more money for you, they're collecting more, which is the incentive for the fund manager to do better, obviously. But you also need to look beyond the expense ratio. Does it include the 12B1 fees? 12B1 is a Securities and Exchange regulation that allowed funds to charge additional fees. You want to make sure that those fees are included in the expense ratio calculation so you understand the total that you're going to be paying. There are also buy and sell fees on some funds. For example, I just use this as an example because all the big trading brokerages do the same thing. You may, for example, have an account at Schwab, and you may go buy a fund from Fidelity through Schwab to hold it in your Schwab account. Schwab will charge you a transaction fee for doing that. This is normal. So if you don't want to pay those kinds of extra fees to buy and sell funds, what you do is you set your account at a place that has the things you want already. Historically, since 1970s, the big giant in the mutual fund industry is Vanguard. They invented it. They invented index funds. So if you want to mostly be an index fund investor, you just set your account at Vanguard in the first place. They have the best deals.
So now I have a question for you, Mike, and you probably already know a bit about what this question is going to lead into. Because over the last couple of days, I did a bit of research on American funds and found out as a European, there's something called a key information document that the fund needs to provide. And the specific fund Mike recommended was Vanguard VHF. It was the healthcare fund. I can't remember the exact ticker. They don't provide that in Europe, so I can't invest in it from Denmark. So what is some of the things the people need to look for when they go in and actually want to find a fund? Because their trading platform might not provide it.
Yes, this is it. This is something that governments and lawyers have loved to get their fingers in everybody's pie, and I'm sure we're all impressed with the intelligence of our local government, but it is what it is. Finance people have found great ways to work with this system. So we'll just take we'll take the healthcare fund as an example. That's an index fund. You can look on the Vanguard website, and every fund will tell you, and every U.S. fund that's traded on the exchanges will tell you their top 10 holdings. So you can copy what the fund owns yourself by buying those 10 stocks. That's one workaround. Another workaround is you go on the Danish exchange in your case and you start looking around. Who are the big trading companies? All the big U.S. trading companies will have some kind of counterpart or partner in Denmark.
Yeah, there is a couple of Vanguard German funds, I know. Germany is the place that hold a lot of U.S. funds.
So that's another workaround is find who the counterpart is in your home country and then call those people and say, okay, I want to mirror this U.S. fund. What do you got for me that you guys are? They'll have something very similar, most likely. So yes, that question. Something that hurt foreign investors or people that are not U.S. citizens many times has been some countries, and this tends to happen more in communist countries, but some countries have such heavy regulations on trading that the individual investors are forced to trade outside their home country. Now you can do that legally, but that's another thing you can do to just, if that's the way it has to be done. It just depends on what your laws are.
Yeah, specifically when it comes to at least Denmark, and I think most of Europe, I would advise anybody to just invest on their native exchange, because
Yes,
in Denmark they does all
much
the
easier.
taxes. They do all your taxes for you. You don't have to go in and check up on all your taxes. They tell you how much you owe them, how much you paid. It's all done. It's all reported. You don't have to worry about it. So I don't think it's worth the headache of getting the Vanguard fund instead of something that would be called a SPA index in Denmark, for example. That's nearly the same.
Right.
But
If it's almost the same thing, then you'll get very similar results.
yeah. So definitely the expense ratio, that I know is the big thing because of the whole compound thing. But another big thing, at least that comes into my head, that's come into a bunch of the people my age group that I've talked to about investing, is which areas should you invest in? We talked a little bit about healthcare. As a Dane, I understand that because our biggest company by miles is a healthcare company, and they make.
Yep.
I'll, I I wouldn't be surprised if they could become bigger than the Danish government.
So you asked what areas. Now
Yes.
this is where we talk about moving from being, now the typical term is know nothing investor. That's not an insult. That was coined by Warren Buffett and Charlie Munger. It was just the idea of people that aren't full time studying companies. That's all it is. A know nothing investor should have investments across a variety of sectors. In general, we think of the market as being in about 10 big sectors. So there's tech, there's wireless communication, which is not the same as tech, there's automotive, healthcare. There's different sectors, but you want to own something in each sector because sectors will rise and fall over time differently. The sectors are generally not heavily correlated to one another. It's one of the reasons the market's broken up into those sectors. Is it's a way to say these are all very different sectors that should perform differently. So that's one thing, and that's another reason for an index fund. An index fund is going to be very wide. It's going to have something in each sector, most likely. To go beyond that and start thinking, well, are there specific things? The question becomes, what's the money for? Do you have a goal to buy a car, or do you have a goal to get a big ski trip? I mean, think about what you want to spend the money on, and then think about, okay, what specific investment is likely to give me a return that I need to be able to pay for that thing that I want within a certain time period. So that's when you look at what we call what's moving the most. Railroad investments. Railroads, nobody's building new rail lines in the United States right now. They're replacing and fixing old stuff, but there's not a large scale production like there was in the 1800s. So if you bought money in railroads these days, what you're buying is, are they going to be carrying more freight than the trucking companies or the airplane companies? Because these are the ways things move in the US. They move by truck, by rail, and by air, mostly. So if you were thinking, well, I need to pay for something I want to buy a year from now, I'm going to buy railroad stocks, that would not be a good sector because railroads aren't likely to climb fast. They will go up over time. But if I need to buy something in a year, I might think more along, all right, what tech companies have new things coming in the pipeline that I'm willing to bet on?
So companies
For example,
where there is like quick turnaround. because it takes, I know railway companies doesn't build trains, but takes quite a long time to build a train, so they can't quite expand as fast as a tech company can.
So you look at, when the pandemic hit, most of the Western world governments shut down most companies in their countries. They told everybody just stay home for 2 years. Most of your Eastern governments in the Eastern world didn't do that. It was a beautiful time to own stocks in Eastern companies because they were continuing.
I still lost money in China during that period.
Well, China is a very special, specific case.
Don't say too much, Mike. Otherwise, we're both dead tomorrow.
No, it's fine. China has their own way of doing things. But yeah, most of the Eastern companies that we were invested in did really well because the Western companies were closed. It's like, well, there's only one person still making stuff. People are going to go there to buy it. So this is things you need to think about. I highly recommend to people, when you watch the financial media on TV or the internet, I mean, that's entertainment. They're trying to stoke up your emotions. Turn it up. Once you've watched it, pretty much ignore what they said. It's not going to help you make good decisions.
I want to just quickly mention this. This is more about mindset, not so much about investing. I can't remember who specifically said it, but know that what you're watching on TV, the media, that's programming. Take in the information and throw away. Discard the programming. Mm-hmm. You're welcome to take it again, Mike. I just wanted to put that in there.
No, that was it, man. That's emotions are your worst enemy as an investor.
So to talk about factual stuff that people can actually use, let's find 3 funds that would be good for, find 3 funds that would be good for mass. So actually, I guess that would have to require me sharing my goddamn screen.
Yeah, one thing I wanted to mention for folks, it's very helpful to go read old investing books, and there are a number of them. abebooks.com, abebooks.com it's a used book marketplace. Go in there and search for books on investing and pull stuff from the 1900s, 1920s, 1930s, so on. Read something from each decade. Start getting some background for yourself. It's super helpful. So now we're in the Danish stage.
Yeah.
Okay.
We're gonna have to see if this page, it might be covered by black. Some places there's probably some shit I need to cover. So basically, the Vanguard Healthcare Fund, we would have to find. We can actually see it here. It's VHG.
Yeah, right, that's the ETF version of the fund. So you click on that and see what comes up.
Yeah, okay, let's start with. This is not the native platform I'm very used to using. Key information.
So that buy button up at the top links it look like you can buy it.
Yeah, but that's if you could. If you are a big time investor, you can. So okay. You don't see too much here in what the fund is divided up to. You would have to actually go into the Vanguard.
Go into overview. Profile.
Where is that?
Up a little bit, and then where you see where it says objective.
There. Overview.
Yeah. See what that gives you. Okay. Now.
We'll just go in Vanguard.
Scroll down a little bit.
We just go Vanguard. Vanguard VHG. Here, this one Mike actually talks about. That's the top 10 most, or the top 10 companies that's weighted the highest within that fund. And
so what you want to pay attention to on the index weight, the far right-hand column, those 10 stocks make up about half the portfolio. So if you bought equal amounts of money in each of those 10 companies, you're going to get a performance is pretty close to what the portfolio is doing.
with more management.
Right.
But you would also not have to pay the fees. So I think if you're a very big investor, this is definitely that would be the way of going about it. If you're a small time investor that's starting out, that's very new to this, I would remove myself from that headache. So I
Yes,
could use
definitely.
more time
Yes.
in looking at the bigger picture and getting a better understanding.
Now
Uh,
I say yes, yes, but I went the opposite when I first started investing many years ago. I started buying individual stocks first, and then later I learned the power of index funds. So that's when I started having some individual stocks that I had to manage all the time, and some index funds I didn't have to think about.
I was just trying to see if I actually could see if I could buy some stocks that follow that index, but apparently it doesn't look like it just by copy pasting it. However,
So
the most you can also always use like the industries.
yes.
Like here, it actually spells them out. Like even niched it down a lot more than Mike like explained, because all of this is healthcare.
Yeah.
All of
Just
it.
different kinds of
Yeah.
companies.
So this would be, and that also is something that then this investing platform provides you with. It's, as we saw before, it shows you the sectors. So you can find a healthcare fund, and then you can do your reverse check, going back and actually searching how does it compare, because it's always you get the most refined result I've experienced by actually going on Google. So, Mike, healthcare, I understand is your number one fund, but you mentioned having multiple funds when starting out. How many do you actually recommend?
Depends on the total amount of cash a person has to invest
Let's
and how
say,
soon they're going to need to spend it.
okay. Now we're gonna put it in my scenario because I can't speak for other people. I'll pull up the full screen again so people don't have to see my Chrome tabs. We're gonna start $2,000. Or actually, $1,000. That's closer to what's in the specific trading account that's liquid, and it's something that's not going to be spent. But the reason why I invested is because when I started looking at stocks and funds, I saw you was able to leverage the 80% of the price of them.
Mm-hmm.
Loan it up to 80% of against 80% of the value of them. Like, so this is a way my money can grow while I am also able to spend it in some way. So it's not money to spend; it's money to borrow against.
Mm-hmm.
So what would be? I get the healthcare. We have $1,000. Is it just healthcare, $1,000, or is it more?
So if you look at the historical charts, the healthcare fund we're talking about versus the Morgan Stanley index, they've moved almost the same
What does the
over time.
Morgan Stanley index do? Just quickly.
It's similar to the S&P 500 that most people are familiar with, but it's a better mathematical calculation.
Okay, so it's a different version of the S&P 500.
Yeah, they're completely different math. So S&P 500 is cap weighted, which means you'll buy more shares of companies that have more value in the market.
Okay.
But those shares usually cost you more because the company's more valuable. Morgan Stanley doesn't do that. Morgan Stanley is equal. So if you had a Morgan Stanley 500, you would say it's with the $1,000, you'd own 2 shares of every company in there, for example, as an example. So yeah, I like the healthcare is a good one. The Morgan Stanley index. Now, you can't buy the index directly. You have to buy a fund that copies the index. But I would go after a fund that copies the MSCI, it's called. There are 2 MSCI indexes. One is US, and one is the whole world. Oh, there's 3. There's a third one that's the world minus the US. So if you're already in Vanguard, you've covered pretty much the world's healthcare companies, because almost all healthcare companies now are global anyway. Even they may be headquartered in the US, they're still global businesses. So you've got international exposure that way. Then the other half of the money I put in a fund that copies the Morgan Stanley index, the whole world. Now, that copies a little bit of everything. It's a good base. It will, I say will, it should grow over time. It always has grown over time. There's a lot of ups and downs along the way. But that's another good base thing to hang on to. And it's not tied to healthcare that tightly. So, for example, if the healthcare sector just has a major problem, everything else in the MSCI is going to be doing better. And you're not going to see as big a drop because you've got the two funds balancing each other a bit. And there is some overlap, which is a good thing to have too. Now, if you're the kind of person that, you just love excitement and adventure and all that, you shouldn't be investing anyway. You're going to get killed. Investing is very much it's about as exciting as watching paint dry, really.
Yeah, it's fucking boring.
Yeah, it is.
It's about patience. It's a good way to train your patience, though.
People who can be patient investors will make more money in the long run over time.
I think most things in life is sometimes patience is the best answer. So there's definitely a virtue and a value in learning patience. So what I'm hearing from you, if a person is a similar position to me, $1,000, then it would be 2 funds, healthcare, and one that covers S&P 500. What is your view on? Because Europe has something similar to the S&P 500, for example.
Oh, yeah. Yeah, they do.
To you, is those two things similar, or?
There's a little bit of overlap.
I mean, because there's like the European companies, the top, I think it's 50 or 100 or something. And every European country also have a short list.
Yes. But the way we think about it, Europe and the United States are both in the Western world. So it's both areas are part of Western civilization, a lot of same style of Western thinking. And in general, in the Western world, a company gets rewarded for providing something that people want to buy. It's the basic concept. So that if a healthcare product or really any product sells well in America, it's probably going to sell in Europe, and Europe is probably going to sell in America. So you have companies copying each other. You have companies buying and selling each other. I'll just use Ericsson cell phones as an example. Ericsson was a separate company. Apple also makes cell phones. So if you couldn't invest in Apple for some reason, you could invest in Ericsson. You're still investing in the cell phone market.
I think that was a bad example. One of them would have been a good investment. One of them was not as good.
Right. But this leads us to diversification. Don't put all your money in one thing. I don't know how many people your age I've seen tell me, oh, crypto. And I'm like,
I thought you were about to say Tesla because that's the other half.
No, but crypto. And it's like, crypto has no intrinsic value. You cannot hold a crypto. You cannot touch a crypto. Nobody can give you a crypto. It's all in the computer. This is not a real asset. This is something that you're hoping someone else will come along and pay more for it than you did.
Some of them do have use cases.
Yes, absolutely. That's why it works, that people keep buying into it. Tesla, and with Tesla, you buy a Tesla, you got a car. It's right there. You can touch it. It's your car.
Yeah, until it... Oh, no, I'm not going to say that. There was a lawsuit incoming.
Until you need to charge it and don't have a station.
No, I was going to say something what a lot worse. Let's say the heater worked a bit too efficiently. Then you wouldn't touch it anymore.
Right.
And some of you will understand what I mean, and some of you won't. But I won't say anymore. We're not going to slander one of the biggest companies on here in the first episode. Unless it's a Swedish company.
Tesla's a good case to look at. They started out, they had a mission, they had a goal. You could, had you been interested, you could have read their reports they were putting out, their press releases, and listened to their conference calls. All along, you would have seen that there was an overarching mission to get electric cars to market. And then it started happening. And then people started using these cars. And pretty soon, had you been paying close attention, you would have realized it was no longer a car company, it was a software company. What they're really selling is the cool software that is in that car. So the question is, if you were to go buy Tesla today, what are you buying? Are you buying a technology company or are you buying a car company? And that's a question an investor has to answer for themselves so they know where that would fit in their portfolio.
So the question to end this off here, because we've talked a bit about investing, it's boring as hell. So what is your, because this is something that I was taught by a Danish person, and he actually had proven results. So I won't badmouth him. It's, if you're Danish, it's Daniel's fingertips. Actually, we'll mention him here. Nice guy. But it was about, he talked about getting 3 tons, and of course you get two of them, like you weigh heavy against. Either you weigh, or you get one that's very broad that you weigh very heavy against, and then you like kind of get a third one that's better, the fun one. You put 10% in there.
Right.
And that could be, I know there's one specifically for driving solutions and the future of self-driving software. All of these companies that deliver this, could be a Rivian, it could be a Tesla, it could be a Porsche with the e-fuels. What is your thought on doing that, of having that kind of a passion fund? I know you say passion investing doesn't go along.
I have one myself personally. I have one for my company as well for the clients. It's something that, it's a strategy that is best used when you have enough money that you're not worried about it anymore. For example, the $1,000 you talked about, you could take $100 of that and put it in the it's called speculation, but you would put that in the speculative or the high risk area. So the other $900 you split between your two basic funds. I never put more than 10% in speculation, and speculation it simply means high risk. It means you're buying into something, but it's really more based about what your future vision is for that company, but you can't really prove it. You've just got a good analytical sense. You've got a good high probability they're going to be able to deliver, but it's high risk. An example of this,
you go ahead.
1977, I was just barely coming out of middle school, and I was reading about this guy, Bill Gates at Harvard, and what he was doing. Now, it's not something a normal kid reads about, but I was never a normal kid. So I'm reading about this guy, and without even knowing any of this terminology, I just said, if I put money in, if I convince my dad to buy me some shares of this Microsoft company, maybe I'll get some money back. So right there, my little brain was already thinking in terms of, that's what high risk means. It means I'm putting money in, hoping the company can deliver, which is why you don't do it with a big section of your portfolio, because high risk can also have a bad crash, right? It can also have a big reward. All you have to do is look at the historical returns from Microsoft to see if you were one of the people that bought it when it was first available, you probably never need to work again.
No. And fun, could that also be, or speculation? Would put those 10% in crypto, in your eyes, would that also be okay?
Yeah, that's pure speculation. I don't do it. The difference in the two examples we're giving here, crypto has no assets. It's just feeling. Microsoft was actually building operating systems. So they had an actual product they could take to a company and say, hey, this is what it does in your computers. is something people could actually see working, whereas crypto is just theory. That's the difference. If you're the kind of person, and I'm not one of these, I just have worked with a number of folks like this. If you're the kind of person who look at crypto and say, I'm going to buy it at this level and I'm going to sell it when it gets to here, and you do that, you sell it, you keep that gain. But if you're the kind of person who's going to buy crypto and say, I'm just going to see how high it goes, you'll probably lose your money because there will never come a time when you're willing to sell. I just saw this with a good friend of mine. He bought the crypto at a low level. It went up and up and up and up and up. And I kept saying, dude, sell this amount. The original amount you put in, sell it and get that back out. So now you're back at even. And all this extra you can leave in. Because if you lose that, you still didn't lose your original principal, right? Well, he left it all in. And he left it all in. And then it started going down. I'm like, sell it. No. So you watch it go all the way to zero.
Well, once it comes to a certain point, it's so low. I'm like as well. I'm like, well, at this point it can't get much worse, so we might as well just leave it in there. It might bounce back once
And
it's
that's
10 cents.
okay if that's not money you're going to actually need. That's fine, but that's why you only want to do that with about 10%.
Yeah, well, I would always say never invest money you're not willing to lose, because
That's a very good, prudent investor theory.
Because you're not in control. Like,
right.
I would rather put all of my money on me than I put all of my money on Tesla or Microsoft, because my name is not Elon Musk, so I don't control what Tesla does.
Right.
And all of a sudden he might get a brain tumor and go crazy and do all kinds of crazy shit.
And the whole reason stocks got started, I mean, this goes back to Roman times. This is an old concept that an enterprise needs to raise cash so they can buy things, so they can expand the business. And so as an investor, what you're really doing is you're giving them money so they can go use that money to build the company up and give you a better value back. That's the idea.
And if it's still not clicking for you, to end this off, I'll recommend you to go up and search the Somalian pirate market, of how they basically build a stock exchange on piracy, because that's a different way of doing it, but it's the exact same principle. Thank you for listening to the first episode. Questions down below are always welcome. See ya.